Welcome back. We're going through adjusting entries in our series of videos right now, and I wanted to share a pretty common one with you, the supplies adjusting entry. This is an example of a prepaid asset adjustment. Businesses buy supplies, they kind of keep them in a closet, or they keep them kind of put away, and then they break in to that closet and use them as they need to. And we're going to kind of show you the accounting for that process. The example that we have in our textbook is a landscaping contractor. Now, a landscaping contractor would have supplies like shop towels, lubrications like WD-40. They may also have things like grease that they put on the bearings of their mowing equipment. And they may also have like fuel additives. That would be examples of supplies. Maybe they keep them in some kind of a barn or a shed, and then they go in and break them open. They use what they need, put it back, and we're going to talk about accounting for that entire process. What we need to know in regards to accounting for supplies, we need to really understand how to account for the purchase of them. And then we also need to account for the use of them. So what we're tracking is how it goes from an asset when we buy it to an expense when we use it. That's kind of the accounting process. From the asset side to an expense when we consume it and no longer have it. So I'm going to just assume that the landscaping company that we're looking at here, that they bought $1,000 in supplies. And they did that at the beginning of the month. We'll just kind of assume that this happened on maybe, I don't know, we'll say 5/1. We'll say May the 1st. And we went out and we bought $1,000 worth of supplies, and we paid cash for them. So I'm just going to put supplies, and I'm going to credit my cash account. Now, we plan on using our supplies up over a number of months here. So I'm going to put it into an asset account and just kind of keep it there, and then I'll make adjustments to that asset account as I use up the supplies. If I were using all the supplies right now, immediately, or within that month, I would probably just go ahead and make an expense out of it. But right now, we're going to record that $1,000 worth of supplies in the supplies asset account. Of course, the offset would be to credit on the cash account, but I'm just trying to focus on what we got going on here with supplies. So, what's going to happen? I buy those supplies at the beginning of May. I put them in the warehouse. I put them in the supply closet, wherever I'm keeping them. And then periodically, somebody's going to go get into that closet, get out some shop towels, get out some WD-40, and use it up. It wouldn't make sense from an efficiency standpoint to do a journal entry or a transaction every time someone got in there and got a shop towel. We'd be making transactions 800 times a day, and that just would not be good from an accounting standpoint. So what we're going to do is at the end of the month, we're going to send an intern or somebody, whose time isn't really that valuable to us, and we're going to send them into that closet. We're going to send them into that warehouse, and we're going to have them count the supplies. Okay? So let's just assume at the end of the month, our intern goes into the supply closet and they count up all the supplies that are left, and they say, you know what? We have $720 worth of supplies left over. That's our ending count. So we have an accounting issue here. We have $1,000 worth of supplies on the books from where we bought them, but in reality, we only have $720 of them left on hand. That means we had used up $280 worth of supplies in the month of May. So we need to make an accounting entry to reflect the fact that supplies have gone from $1,000 down to $720. So at the end of the month, at the end of May, there's 31 days in May, or 30. 31. Sorry about that. Okay. So 31 days in May, at the end of the month, we did our count, and now we have $720 left. So we need to make an adjusting entry to bring our supplies down from 1,000 to 720. We need to account for the fact that we used up $280 worth of supplies in the month of May. Our entry, all we're doing is taking that asset and turning part of it into an expense to show that we've used it up. So I'm going to debit supplies expense. And I'm going to credit that asset account, supplies. So all I've done is I've taken the amount that we've used up and moved it from the asset supplies to an expense account to show that we've used it up. Now, this is an example of a prepaid asset adjustment. We paid $1,000 for an asset up front, and we're going to make adjustments to it as we use it up. We could have adjustments of the same nature for prepaid rent if we paid rent early, prepaid insurance. It's kind of like if you bought a prepaid phone card, like a Walmart or somewhere. You pay your money up front, you have that asset in your hand, and you're using it up as you use up the miniature, as you use up the data until it's eventually worthless. And then you refill it, you got a prepaid asset that you can use up. It's the exact same concept from an accounting standpoint right here. So the issue you have is basically just recording your supplies when you buy them, or whatever asset you're talking about, rent, prepaid insurance, and then as you use it up, making an adjusting entry, taking it off the asset account and dumping it into the expense account to show that you have consumed it or that you've used it up. That's the simple supplies adjusting entry. If you have any questions about that one, please let me know.